Hey, it's Joshua Bellinger, and welcome to today's Trade of the Day. So what we're going to cover here is what I follow in the financial markets. I want to know where big money is positioning themselves. And specifically, what's more interesting is big money, the whales, positioning themselves out further contracts. So one of the ways that we always find great opportunities and using leverage is in the options market. And with the options, we can find where the whales are swimming or looking to position. So here's one of the trades that I came across today. And it's interesting because it's cheap bets that make and yield big returns. So if we take a look here, right now we're looking at Cleveland Cliffs. So I already have the option montage open here. And if you take a look at that January contract that expires 591 days from today, you'll notice that there is some volume there. And what happened here was a institution or a big money trader, fund, whomever, somebody with some deep pockets put on a position here. These are the interesting types of trades that I follow, what I call high impact trades. And the reason why is because, again, this is where the money's going. I want to know where money's going, not where people think that the market's going to go. People who put money where their mouth is are the people who make money. That's why we follow them. So take a look here. We see that 10,000 contracts traded and 21,000 of the January 10 contracts traded here. So what we can identify here in my system is I can identify where these traded at and how these were executed. This was one trader or one person entering this position. And they had bought the fives and they sold 2 times the many of the tens. So what that is known as is a call ratio spread, meaning that they bought one and sold 2 times as many. And what that indicates is that they think prices are going to stay above or below that 10 level. And what I mean above, so what that indicates to us is that they, in the next 591 days, believe that $10 is the ceiling on prices. And they're going to play from $6.83 right now to $10. So this is a structured option position. And there's a lot of detail and information that is provided here that we can use to our own advantage and make money here. So if they bought the fives and they sold 2 times the many as the tens, they put this position on for a 50-cent debit. So it would look something like this. So I'm in a simulated account just to walk through it and make sure that in my own account I don't actually have any positions or anything that has opened the next day. So here we have a 10 by 20, so 10 contracts by 20, so 1 by 2 again. And this is the 5 call selling 2 times the amount of the 10 call. Normally this would be a vertical spread, 1 by 1. This is 1 by 2. So again, this is a 50-cent debit. 50-cent debit that they put this on for. So if we take that 10,000 contracts and do 50 cents, which is times 100, $50 times 10,000, $500,000, a $500,000 bet on this position here. And this is a structured position. This is not something that they just put out there for no reason. This is what they think is going to happen. So when we look at the chart here, we could see here that $11.61 was the recent high going back to July here. So going from the next 6 months here, maybe 6-7 months, they believe prices can get back to that level. But what they're using is options, and they're using a strategic type of approach to make their bet pay off and use limited amount of capital. So if we take a look here at the Analyze tab, you can see here that having this trade in here, and we have some break evens and price slices on here as well, but the green line indicates the profit potential as prices go higher here. So as I slide the chart here, as we see the green line, what we see here is that at $10, this is where the max profit is going to be on this position. And it looks to be about a 13% return on that. And if it were to go past $10, this is where the profits start to diminish. So that peak, $10 is the peak where that's the max that they will be able to make on this position at January expiration here. Now, if prices go past that, this is where they start to lose money. And you can see here, it can actually go all the way to nearly $13 where they start to lose money. So the reason this happens is because when you short the 10 strike, it's a 1x2, that 10 starts to work in your favor as you get up to 10 because you sold it, so you collected that premium. Now it works against you because now you're short it, and if prices continue to go higher, you can see here on the graph, that's where the profits start to diminish. So the peak price of this is $10 is the ceiling. This is where they think that prices are going to stay within the next several months. And looking at the chart and looking at everything else, I mean, it's a structured bet that can really pay off here. There's different ways that we could look at this and doing it ourselves. You could just do a 1x1 call spread. You could do a 1x2 for 50 cents. And these are the types of opportunities I like because you put it on and we're not trying to day trade or scalp options here. We're putting on structured positions. We're being savvy. We're letting things play out. And we can diversify with different expirations and different types of option strategies. That's how we build a portfolio or build an overall approach using options. So this is one of those high impact trades. Very interesting, Cliff. I mean, it's a $6.83 stock, but you have a couple dollars of upside. Instead of tying it up in stock here, you can use an option strategy such as this. And this is where some money's going today. So we'll talk to you in the next episode. Take care.